I think we're late stage, maybe third quarter.
The market dynamic is changing, right? Like the ETF buyers and the digital asset treasury companies are now the most significant marginal buyers. So they're the ones who move markets.
So that by nature means that there can be a redefinition of what a cycle is because the market positions within it are different. We're getting an elongated cycle. Our guess would be that next summer or fall might be the peak.
This episode of Other People's Money is brought to you by VanEck semiconductor ETF SMH. As you may know, SMH is the largest semiconductor ETF by AUM with over 25 billion in assets. What you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that has been intelligently designed to capture low capex, high-margin chip designers setting the next stage of AI. More on both later in the show. Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Pure Crypto or any of their funds. Everything is meant to be informative. Welcome to another edition of Other People's Money. I am joined today by Jeremy Boynton and Zach Lindquist, managing partners of crypto fund of funds Pure Crypto. Pure Crypto was founded in the crypto bear market of 2018 and focuses on allocating to established, long-biased, liquid, and venture crypto funds. Thank you both for being here today.
Thank you for having me.
Yeah, thanks for having us.
I'm very excited. You're the first crypto fund I've had on. It's something I've been trying to do for a while now. And obviously, you guys have been around as far as crypto funds go for a while. So I think you have a very interesting perspective as well, being an allocator to other crypto funds. So I don't want to bury the lead. Since inception through 2024, your fund is the best performing fund on Preqin, delivering over 11x net return over that period. 2025 has been kind of a funny year in the crypto markets with strong enthusiasm at the outset and no shortage of volatility along the ways. How have you, and by extension, your managers, done in this current environment?
2025 has been a difficult year for crypto fund managers in particular because Bitcoin has kind of eaten all of the performance. And if you're a fund manager, you're not holding just Bitcoin, and many aren't holding any. So in years, it's similar in 2019 when Bitcoin was up, I think about 100%, and the rest of the market was about even. Those years are difficult for fund managers, but our view is to look at this from a full market cycle perspective, which tends to be somewhere around 4 or 5 years. And, our goal and the goal of our managers that we invest in is to outperform over a full market cycle, right? So that includes a full bear market and a full bull market. And so we know that the majority of the outperformance isn't going to come in a year like what we've seen in early 2025. We still have a few months left in the year, but yeah, I mean, unless you're holding Bitcoin right now or Bitcoin treasuries, you're probably underperforming that asset.
I might chime in and say the market structure is changing this year dramatically in a way that it didn't change in prior cycles. The advent of the ETFs and the digital asset treasury marketplace has exacerbated the trend that Zach is talking.
Certainly, those treasury companies have gotten a lot of press in the TradFi space. Are they capturing as much attention in the crypto world? Because I do feel like sometimes there's a good crossover between what the TradFi world is looking at when it comes to crypto, and sometimes you guys are kind of just like off on a completely different planet.
No, that's not the case here. I can guarantee you every one of our managers is writing about it. They're thinking about it. They're adjusting to it. They're looking themselves in the mirror and trying to make sure that on a first principles basis, they're still pointed the right direction.
Like Jeremy said too, the market dynamic is changing, right? Like the ETF buyers and the digital asset treasury companies are now the most significant marginal buyers. So they're the ones who move markets. So I think in the crypto world, it's less about investing in these digital asset treasuries as it is kind of tracking who's buying what, which ones are launching, and how that's affecting the markets.
We are starting to see some talk of treasury companies for non-Bitcoin assets as well as ETF products. We're not quite there. How are your managers looking at the potential for this to move beyond Bitcoin, this trend?
Yeah, over the last few months, Ethereum has outperformed everything because Bitcoin ETF buyers have experienced great returns for a year now when it launched in January of 2024. That's the best performing ETF of all time. Now we're starting to see there was really nowhere for that capital to flow out the risk curve. But now with the Ethereum ETF live, and we believe the Solana ETF will be right around the corner here in the next month, I think we're going to see the capital rotation kind of move from Bitcoin to, Bitcoin only to Bitcoin plus ETH plus Sol. In our view, and I think our manager's view, is that over time, maybe in the next 12 months, or maybe it takes a little bit longer, the entire market's going to get indexed, and there's going to be an ETF for just about everything.
I would even add to that our conversations are actively seeking to participate in some of these digital asset treasury, and in some cases considering sponsoring them.
Interesting, because I know that there's somewhat of a bifurcation between managers in the crypto space, between the people who have this long bias. They're trying to still find alpha, but they're not doing as much of the market neutral trading, market making that some of the other crypto hedge funds are doing. Certainly these treasury companies have been very interesting in the TradFi space because of the just interesting capital structures that they have. What is it about these treasury companies that is attractive to this more directionally long biased investor?
Question. MicroStrategy, now called Strategy, historically has traded at a pretty attractive premium to its net asset value. At this point, their business is meaningless in terms of the size of their market cap. So it really is a great example. And I think everyone's looking at that, trying to replicate it in some way. I'm not confident that I know for a fact, not every treasury company is going to be trading at, some multiple of their NAV. In fact, some might be trading at discounts or continue to trade at discounts based on a number of factors that they're taking leverage or what their business looks like with the strength of their balance sheet. So I don't know how it all plays out. Every crypto bull market is marked by excessive leverage somewhere in the system. To me, it seems like a lot of these, maybe it's not Strategy, but maybe some of these other treasury companies out the risk curve are kind of creating that leverage that obviously fuels a bull market, but ultimately leads to a blow off top and a pretty nasty bear market after. But I don't know, Jeremy, what are your thoughts?
Yeah, I think it's sort of two different stories. I think that's absolutely correct. As it concerns Bitcoin and Ethereum specifically, those assets, well, in the case of Bitcoin, there's no cash flow. In the case of Ethereum, there's negligible cash flow. So using an equity wrapper to buy more only works as long as the equity continues to vote. Like it cycles quickly on the way up and quickly on the way down. You just don't know when the market psychology is going to shift. There's not an actual structural virtuous cycle being created with the actual underlying financial economics there. However, with Solana, that's different. Solana tokens you staked Solana tokens are currently yielding 8% and moving higher. And there is an arbitrage there. There's a structural arbitrage where the cost of capital, be it equity or debt, can be several hundred basis points below that, and leveraging the capital creates an interesting financial model. So if it ever works long term, I don't think it's going to work long term for Bitcoin and Ethereum. By that I mean by multiple cycles, but there's a real world case where, because of the crazy cash flow, in addition to the upside growth opportunity in Solana, you can make the case for it working.
You talk about these full economic cycles, or the full Bitcoin cycle at least. 2022 was the last major bear market. When you look at the environment right now, where are we in the cycle?
I think we're late stage, maybe third quarter. We're expecting the market, certainly because of the traditional cycle, being a 4-year cycle. People like to talk about the 4-year cycle, but I think that cycle is getting longer. The capital participants that are in the ecosystem today are not the same ones. The marginal buyers are not the same buyers that were in the ecosystem 2 cycles ago. So that by nature means that there can be a redefinition of what a cycle is, because the market participants within it are different. So we think we're getting an elongated cycle. Our guess, and we don't need to be right on this to make money, but our guess would be that next summer or fall might be the peak.
We could have seen a normal looking cycle, especially once Trump got elected and there was a lot of excitement in the crypto market. I think that got delayed, not just because I agree with Jeremy that the cycles seem like they're taking longer. I think a part of it was delayed because the rate cut cycle was delayed due to the tariffs and the trade war. I think Q1, Q2 was almost like a pause. Like everyone was excited about crypto in January. Trump's the first crypto president. And then all of a sudden attention turns to, wait, what's he doing with all these tariffs? Right. And then it's like, okay, pause that excitement from February till, June, basically. The market sold off pretty aggressively. Altcoins sold off very aggressively. And then kind of June, July, we pick it back up with, okay, the stablecoin bill's going through. They got the market structure bill that's going through. The Trump administration is keeping their promises to the crypto industry. That was the big concern maybe when in November was this all talk. It seems like they're following through on it. So there's a lot of tailwinds now. And I kind of agree with Jeremy. Sometime maybe Q1, Q2 of next year, we'll see a true parabolic rise. But there's an argument to be made that Bitcoin doesn't experience an 80% drawdown again. It's, if it's truly crossed the chasm into being an institutional product, there, and the marginal buyers are, institutions, advisors, ETF buyers, corporate buyers. Maybe you don't see any more than a 50% drawdown again. That's, I don't know if that's contrarian or if that's what most people think, but I kind of believe Bitcoin's maybe Ethereum and Solana will take another cycle to get there. But I think Bitcoin's kind of crossed that chasm now.
Zach and I are comfortable, slightly disagreeing about things, but we've said that every cycle. Every cycle, we said Bitcoin's past the threshold, right? I mean, the NASDAQ in a nasty correction goes down 50%. And I feel like we're further out the risk curve than NASDAQ, but who knows? I mean, these are not exact science. They never chart the way you think they will. It's a messy business.
I'm interested in the crypto industry's views on Trump. I feel like obviously people were extremely enthusiastic coming in. I think Trump coin caught a lot of people by surprise and said, hey, maybe just focus on the policy stuff. As people who you talk to a lot of people in the industry, what did people make of the Trump coin decision?
From the people I've talked to, it was a huge surprise because it kind of happened in January. And I think it happened at one of the during one of the crypto DC events, and everyone was kind of thrown off guard. And, it definitely feels like meme coins are a grift. At the end of the day, they don't provide any real services. There's no product. It's, it's hard to know what exactly you're betting on with Trump coin, but if you know Trump well, you probably get a sense that like he's going to be pretty invested in seeing that coin go up over time. And so I think that got people who are meme coin speculators pretty excited because it's a meme coin backed by a really wealthy, very powerful person who's very invested in his own image. So from a meme coin standpoint, I can understand why it went up so much. That's not interesting to us. Meme coins aren't interesting to our managers. It's not what we focus on. However, meme coins, the vast majority of trading volumes happen on Solana. And so it is, when volumes spike like they did in January, Solana, rose to about 290 because of all the activity on chain. That is obviously good for us, good for our portfolio. We are long Solana through our managers. So we're not really playing meme coins directly, but at the same time, we can kind of benefit from that trading volume.
Yeah. To answer that question another way, crypto's opinion of the Trump coin actually, in my anecdotal experience, has more to do with what side of the political aisle you were on than anything else, which isn't interesting to us at all. We're more interested in shouting the news about what he's doing on the regulatory front and the political winds of change that he's sweeping through Congress to be going from an anti-crypto to a pro-crypto agenda. So those are things that are going to affect us far greater and for far longer than the Trump coin.
I agree with that. Depending on what you think of him before that, Trump coin and World Liberty Financial, which is their other token that the Trump family's launched. It's either you're pointing this out, you're screaming about it, or you're just rolling your eyes and being like, I'm just going to focus on what the administration's doing for to really impact the crypto market, legislation, the SEC, so on and so forth.
And as far as the regulatory landscape goes, certainly the SEC, there's been a massive sea change. But as you mentioned, even within Congress, there used to be many. I think Elizabeth Warren still counts herself as an anti-crypto politician, but I can't name a major politician who's come out with a pretty anti-crypto stance. What about that change in just the attitudes from the leaders of our government?
I think the Liz Warren anti-crypto army is dead. I think that movement's dead because I think they saw in November that it did move the needle. It moved the needle for Trump. There were some Democrat Congress people who lost races, and because their cryptos rose up and funded some of their opponents, I think Sherrod Brown is one of them. So I think there's no, people own it now. So if you're going to come into Congress with an agenda to take down this industry, you're going to be hurting people's wallets directly. And that's just a losing strategy.
Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC and through to equipment makers and software developers. Its market cap weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHmax to learn more. Building on the design and success of SMH, VanEck saw an opportunity to launch a fabless semiconductor ETF, SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimization and applications at the edge. Go to vaneck.com/SMHXmax to learn more. And now back to the interview. Well, I want to zoom out a little bit. We've talked about bear markets. I want to go back to your founding and 2018 and the decision to launch this fund of funds in the teeth of what was really one of the nastiest bear markets, and maybe the last time when Bitcoin is dead, I think really had some teeth to it after that 2017 top. So what did you both see at that period of time that said, yeah, this crypto isn't dead, Bitcoin isn't dead, and we should be getting in with some of these very early fledgling managers in the crypto hedge fund space?
Really, the decision to launch was before the bear market started. I mean, our timing was not good, but it was a brand new technology that I began to research in March of 2017. So we were squarely in the middle of a raging bull market. And I just kind of went down the rabbit hole trying to figure out what it was and how we would figure out a good way to allocate to it. And it showed a lot of parallels to an experience I had much earlier in life in college. I was graduated from college when the internet was born. And we actually did research in college in my senior year about, whether the internet was going to exist or not, and blah, blah, blah. And I was the naysayer. I was the guy who said, no, it'll never work, and get out of school. And clearly a couple of years later, I'm like, well, I missed that one. That'll never happen again in my life. And so I was prepared to see that very similar tech profile in 2017. It just happened to be dumb luck that we launched January 18. We didn't know. We thought it might be, but even though we thought there was a chance that it was launching at the top, we felt we were so early that it wasn't going to matter. We weren't looking at this as a one cycle idea. We were looking at this as a multi-decade opportunity that was going to be transformational technological advancement for society. So it was easier then. After we had done it, made quite a bit of money for us and for our clients, and then experienced the second one, that one got a little harder because then you got skin in the game.
If we had launched the fund in the true teeth of the 2018 bear market, that would have been like October, November of that year. We would be up, if we had done that, we'd be up probably 20, 30x or something from that point. We did, Jeremy did a lot of the capital raising in the back half of 2017, and that capital then launched January of 2018. And it is tough to first year in a new fund to take a drawdown like we did. but I think we pitched it with discipline. We've always told investors that, well, the pitch has changed since then, but back then it was, 1 to 2% of your portfolio that if it goes to zero, it doesn't change your life. But if we're right about this, it's going to be meaningful. It's going to move the needle in a big way. Today we're not pitching this as a go to zero industry anymore, but it's still very risk on. It still should be part of your portfolio that you are willing to take risk with. So I think the discipline with which we raised the capital, we found good managers, we weathered the storm. We didn't have a flood of redemptions in that bear market, and we didn't have a flood of redemptions in the 2022 bear market either. So I think discipline in how we pitch this, how we communicate and try to over communicate to our investors, I think has gone a long way to helping us.
And what were the manager selection process look like at the beginning? And I know you've generally stuck with those day one managers over moving towards some of the new entrants to the market. So I'd love to hear about how you DD'd the first round and why you've stuck with them despite so many new entrants into the space.
This is a point that I'm particularly passionate about. If you're familiar with hedge fund of fund structures, it's a structure that's been around for decades. But most of the time it's used for mitigating risk. It's kind of a market neutral, scrape an 8%, return without it, minimizing volatility. And consequently, you'll have 20 to 25 managers. So you're swinging 2 to 3%. Maybe your star manager gets a 5% allocation across the portfolio. This is not what some of our peers are actually doing that in crypto. Because of that, their returns are significantly muted. We took from the get-go a very opposite approach. We wanted to be concentrated in just a few of the smartest guys in the room that we could find. And so, it's actually harder to do that today because the sea is so much bigger. There's so many more people in it. But back then it was a smaller universe, and that universe just was not used to advisory. I run a multifamily office. They were not used to multifamily office guys looking to invest. And so the doors were just swinging wide open. They were willing to talk. So I got on airplanes and went all over the place, and it was fortuitous for us that we came in when we did, because I didn't have any competition for calendar slots with the people that we ultimately found, which we still continue to believe are the most successful guys in the room.
We started with 5 core managers, and we've since reduced that down to 3, and we've added some venture managers as well. And we've really stuck with them because I think we value what a bear market, how a bear market shapes the team, the managers' acumen. I think that's the problem with new managers. They haven't managed other people's money in a bear market yet, or if they have, they launched on the tail end of 2022. There's just so much you gain from learning, going through a bear market, how to manage capital, how to avoid chasing things, how to avoid getting shaken out or taking leverage, and respecting the counterparty risk that exists. I just think those are lessons you have to learn by being in the market. And so we value our manager set because they've just been around. There's a huge value add to that.
To piggyback on that, the crypto is the combination of really deep science and open source coding and cryptography. If you were good at that before 2021, maybe, you probably were naturally drawn to that ecosystem already. So a lot of the players that are coming in now are TradFi converts, which is fine. And I know that's going to be, that trend will certainly get bigger, and eventually there's going to be really great, managers that come out of that. But for now, in this very, what we think, venture capital-esque risk return profile, we're much more comfortable with the crypto native allocation decisions.
So naturally, if you launched Jan 2018, all of these managers were pre-2017 or 2017 at the latest, if not before then.
Yeah.
When did the crypto hedge fund space really even start? Like what is the first class?
So Pantera launched their Bitcoin fund, I believe, in 2016. Is that right, Zach?
No, earlier than that, I think.
Whatever it was, but they were early. Most of the crypto native best managed, there's probably, in my opinion, I don't know exactly, a dozen that the market would consider world class. Sort of either uh, hedge fund, meaning or combo hedge fund and VC. And virtually all of those were the 2017, like mid to late 2017 vintage.
There's really just maybe less than 5 too that were pre 2017. You got Pantera, Polychain, Metastable, and then there's probably a few that we haven't heard of. But the 2017 class was like the first bigger hedge fund foray, like the bigger immersion of hedge funds. And so we've had conversations with basically all of them, because like Jeremy said, there was only maybe a dozen to go talk to, which makes the due diligence a lot less stressful because you don't have that many to choose from, right?
Anybody who's been on Preqin or any of these databases knows just how many options there are in the supermarket of funds out there. But the venture funds are very interesting because obviously crypto has just such an interesting way that it trades, with everything having some degree of liquidity. So I'm interested to hear what allocating to a venture manager looks like and what a venture investor in crypto is looking for.
What's funny that I think a lot of people don't understand this about crypto funds. They're all kind of doing very similar things, the venture guys and the liquid guys, because the liquid funds are creating venture side pockets for their LPs, and the venture guys are siphoning off 10, 15, 20% to invest in liquid ideas that they then recycle into more venture ideas. So they're all like, it's either mostly liquid with a side pocketed venture, or it's venture with side pocketed liquid. And you're just kind of playing one off the other a little bit. So, and then if you take the full scope of the crypto market, everything is really venture capital at the end of the day. These are startups. A lot of them are pre-revenue. Even when they ICO, a lot of them are pre-revenue, right? So we treat it all like venture capital. So it's really just comes down to the liquidity terms of the fund. And so, and you asked specifically about venture funds. I think there was an initial explosion of venture funds primarily because they were more palpable to go raise capital with more institutional or family office type investors, right? They wanted to go find the infrastructure plays in the crypto market, and then they wanted capital that was locked up, and net asset value strike once a quarter, but they didn't have to deal with LPs, redeeming at the bottom of a bear market. They got to, run the thing for 10 years. And there was a lot of great venture plays out there, but I think they overraised. I think there's too many venture funds. There's too much capital chasing too few good deals. And so that's why you get this dynamic now where tokens or teams are launching their tokens, their ICOs, and the token just goes down in a straight line. That's generally the pattern we're seeing in the market. And that's because there's too many venture dollars and the valuations are too high. And there's not enough people on the liquid side who want to take the position at that price.
Which also makes it extremely important to be allocated to the best venture capitalists in the game, because everybody's basically developing a pool of talent inside their structure to win deals, to say, hey, if you come with it, we're not just capital for you. We're not just writing a check to make your business go. We've got a deep bench of people that are going to help you nurture this business. And so it becomes a war for talent, so that talent wins you deals. And there's only a handful that really play that game well.
If you followed this space for a long time, everything was going to happen on the Bitcoin blockchain, and then it was Ethereum, and now we have Solana. And, as you said, a lot of these cryptographers, like I remember hearing from, very, very experienced cryptographers who have been studying this long before Bitcoin, come out with these interesting ideas. And then you haven't heard about the token or the technology for years. So what is the hit rate like for a venture investor? Does it mirror the traditional venture world? And when you have a hit in the venture world, what are the returns like?
From what I've seen, I think the hit rate's a lot higher, and I think the upside on your winners is higher relative to the time that it takes to hit that number, right? So I think in crypto, you can get 1,000x from a, seed stage investment that does its ICO and the token goes up in value. You can hit 1,000x in a very short period of time because the distance, the time distance between seed stage and ICO with a liquid, markup could be 4 years, right? It could be less than that too. It could be a few years more. So I don't think you see that in traditional venture. I don't think you see 1,000x's in 4 years or 5 years. Maybe you do, or maybe they're fewer and far between. The interesting thing about crypto is you can also, once you have a liquid token, you can take your bet off. That's basically an IPO. And so if you get early liquidity, there's a way for you to exit, or at least exit with some portion of the profit, even if you don't believe in the idea over a decade or more time frame, right? So you can actually win on some long-term losers, where I think you just don't see that as much in the traditional venture market, where you're kind of in for the ride, and IPOing takes a lot longer and you're making a bet a decade into the future. That's just not the same, I think, in crypto.
I would just add, I'm not so sure about the hit rate being higher. I totally agree with Zach on the timing issue. Traditional venture capital, if you hit a home run 1 out of 10 times and that returns 20 to 30x, you could lose everything in the rest of your fund and you still win. It is true. Like for instance, in our first fund during the first cycle from 2018 to peak in 2021, we had 3 1,000x experiences. I don't know that that's I know it's not. I don't think it's possible in venture, but I'm not sure it's possible going forward in crypto. I think as the ecosystem matures, I'm not sure we're going to see 1,000x ideas. Maybe we do. I would love it if we do. But I do think we'll see 100x ideas. I think we'll see 200x ideas. And even that is far better than, what the normal venture capital world will give you. And the other side of the mitigating thing, where I feel like the comparison between the two is better in crypto, is that liquidity, like Zach said, comes way, way faster. So you can actually, in fact, one of our 1,000x's was ultimately a failure. It was actually a project that didn't work, that we made a lot of money on because we got liquidity early enough to say, well, it's time to take something off the table. So that doesn't happen in traditional venture capital.
Well, to the point that crypto venture has caught some flack from people in the traditional venture space. There was a period of time when Chris Dixon at A16Z was sort of getting a lot of heat for some of these sweetheart deals where they got preferential liquidity, they got the ability to exit these things that, as you said, maybe you're long-term bearish on the idea. What do you think about the fact that this liquidity does misalign somewhat with the traditional venture model?
I think that's an unfair criticism, because it's not like A16 was willingly betting on a bad idea to suck money out of the market. They only put capital to work on things that they're excited about. And so, but it's like Mike Tyson says, everybody has a plan until they get punched in the face, right? When you wake up and you get punched in the face and you realize this isn't working, that's our job as allocators, to figure out how to rescue capital. So I think it's kind of a BS line of reasoning to think.
Well, A16Z raised a ton of capital, and when you have as much capital to put to work as they do, you're gonna be able to negotiate those type of terms. I think what investors didn't appreciate is, like, you can, with most projects, you can go look up the token distribution and the lockups and the vesting period. And so if a token ICOs and A16Z is, let's just say, 20% of the supply, and they don't have any vesting period, it's just immediately unlocked. Like that should be part of your due diligence as an investor, to be like, okay, I know a venture fund that's profit seeking for their LPs is holding an enormous amount of the supply. Here's the volume. It's probably prudent to wait, right? Like if they have those preferential fee terms, and you should be able to see that in crypto and make a decision based on it. And if A16Z wants to liquidate, it's their right to do that, right? Like they're a venture fund, they're trying to deliver returns for their investors. But you should be able to see that. It should all be transparent. You should be able to make a decision based upon that.
So you guys, you have the three core liquids, you have this venture portfolio, let's call it 10, a dozen or so managers, and you're not trying to be the diversifier that many fund of funds are trying to be. Naturally, the question for most people would go, why wouldn't they just go direct to these managers if that group of people, that cohort is so small?
My answer to that, curious if Zach has a different, is, we actually help people do that. I mean, if you're writing big enough checks, and you want to spend the sweat equity to be on top of it, that's the truth. We have helped people think about, made introductions to managers and do that. But, short of, I don't know, certainly short of $10 million, it's hard to replicate, number one. And there's an absolute equity that you got to earn and staying on top of those manager sets. And it's not quite as easy. But I mean, for a $500 million family office who wants to put a $20 million sleeve together, absolutely. For a $50 million family office that wants to put $2 million in it, it's just not possible.
So
Yeah.
what are the minimums like? It's just so different. Obviously, crypto is huge. The asset class has grown so much, but still in the grand scheme of things, when you compare it to the credit markets, to the equity markets, the amount of liquidity just isn't quite there. So what is a big fund on the liquid side and on the venture side?
Yeah, I think the liquid funds, the biggest and the best, are managing multi-billion dollars today.
Right.
And most of that has been because they've grown it organically, not because they've raised it. The best ones. And there's some out there that their performance is relatively average and they've just been really good at capital raising and staying in the market, and they're managing a lot of money too. The ones that we love, the best managers in this space, are able to still take concentrated discipline allocation in a multi-billion dollar fund. So that's kind of the liquid side. The venture side ranges, right? Like we prefer managers who are managing smaller books because they're able to go take more concentrated positions and they're able to go get those positions in the seed rounds. So we're not participants in the, $1 billion A16Z funds that, are focused more on later stage rounds. So
Totally. Yeah. It depends on what side, what space in the venture capital maturization curve you want to play in. But we're definitely earlier stage.
And
ranging
are,
between 50 and 250 million.
with the returns that the industry has had, are they even interested in raising capital? They have so much from this organic growth. What is their appetite like for new investors?
Certainly on the venture capital, they are, because those are structures that have an end date, and so they have to continually re-up every 4 or 5 years. So consequently, though, the better ones that actually hate the actual process of capital raising, because it's not why they're making all the money. They're making money because they're good at making decisions. But ironically, at the same time, their returns are so good, they never have a hard time raising money. They're always 5 times oversubscribed, and people are fighting and calling to get the allocations they want. So that to me is the picture on the VC side.
I don't see a lot of these big liquid funds doing a ton of capital raising efforts. I mean, when they are, it's probably behind closed doors with big institutions like endowments, pensions, family offices. If you're managing over $1 billion, the 100K check isn't as meaningful. So I don't see a lot of the really good hedge funds out there. They're doing a lot of education there. I think their efforts are focused on DC and trying to help educate Congress people and help move policy forward. That's just a better use of their time than I think just, typical capital raising events.
The $1 billion clubs, hedge funds in the space that I know, they're not taking $100,000 checks.
Yeah, what are the minimums like?
If you had no prior relationship to them, I have no idea what the minimum would be. I know the liquidity terms of the liquid hedge funds now aren't as beneficial as they used to be. Back in the 2017 era, it was a 1-year lock, and then I think quarterly redemptions with like a 30 or 60-day notice. And that was just kind of across the board. The best funds today are much less liquid than that. It's more of a 2 to 3, 4-year even lock
And,
with quarterly redemptions, but with like a investor gate. So it's just a far less liquid structure
and
today than it was.
the cool part is our LPs who've been with us since 18, the first fund, we still have the early liquidity. So, right. Cause that's what we signed on the docs.
Well, it also creates another opportunity, which I know that you guys play in, which is the LP secondary market. Certainly been very, very popular. Tends to get more popular in the bear markets. So can you talk to me a little bit about the LP secondary side of your business?
Once the tide went out in 2022 and we saw who was swimming naked, I think the opportunities came to us. We didn't even go look for them. We didn't even set out with funds 1 and 2 to go tackle opportunistic secondary market opportunities. But they found us because the FTX estate being the biggest, their estate was selling off a whole bunch of private market assets ranging from, I think, Anthropic AI allocations all the way through, crypto venture funds. And so when I saw the list, I was like, well, we know those guys, or we're invested in one of them. So we're already LPs. We know what the book is. Let's bid on the asset because it's a bankruptcy estate and they're doing some sort of blind auction process. And so if we're already LPs and we already know what's in the book, then we kind of can value how we want to price that asset, right? So we went out and bid on those assets, and we were, I think, by far the most competitive bid. By the time we got docs signed with the FTX estate, it was 3, 4, 5 months after we initially put in our number. The crypto market had rallied pretty significantly. We were getting really excited about it, but they were kind of requiring us to come up with more capital to take down bigger chunks than we really could handle with our fund of funds. So we ended up not getting to close on it. They kind of backed out last minute. And that would have been a real sweet opportunity for us. And that was what kind of sparked this idea of let's go get capital that we can tap if this kind of thing happens again, because that would have been a grand slam and almost like an immediate 3, 4x on our invested capital from the moment we signed docs. So I think that was kind of what originally sparked the idea, is like, hey, let's not let these opportunities pass us up again. Let's go raise capital that we can go look for them even. And so we ended up closing on a smaller deal with the Three Arrows Capital bankruptcy estate, kind of similar situation. And it's been one of the best investments in our fund.
We're not saying that we think there's going to be that kind of bankruptcy liquidation event again. But just even going back to the liquidity profile, getting getting longer over the course of time, we do think that bear markets are not over. And African peak, there's going to be a drawdown, and there's a lot of LPs that are buying in right now today to the crypto ecosystem, and will be over the course of next year. We think they aren't even thinking about liquidity terms, and they're going to get to the point where they want to hit the eject button, and they're going to realize they can't. It's going to take them 3 or 4 years, and there will be a subset of those that want to puke it up. And so we're launching a new fund in Q4, and a big portion of that fund is to make sure that we have capital set aside, and we're fostering relationships with our managers to say, hey, we want to be your go-to guys on these secondaries. If you got LPs that are causing you trouble and they need liquidity, then come to us. And so we're hopeful that secondary activity will be a meaningful allocation in the next fund launch that we have, based on the experience, the small amount of anecdotal experience we were able to get to in the last cycle.
Yeah, and is that like a traditional drawdown vehicle, or the money's already there and it sits on the side?
To draw down, yeah, it will be a drawdown vehicle.
I want to ask about some of the other new entrants in the space. Obviously, in the TradFi world, the multi-manager, market-neutral hedge funds are sort of taking in all of the assets. There have been a lot of new entrants into the crypto space. Obviously, with the different liquidity profiles, the wider spreads, it's attractive to that type of trader. But that's not an area that you guys have gone. Why have you stayed away from that style of crypto exposure?
This probably goes back to sort of a blending of our crypto, you know, due diligence and sort of body of knowledge that we developed over time, but merging that with my experience as an allocator in a family office setting. The market neutral world is a very finicky world. It's basically an arbitrage where people chase market participants around the merry-go-round, trying to figure out how to get in front of the line until everybody else figures out how to play the same trick. And it's not a stationary idea. The thing that works today will almost certainly not work 18 months from now. So it's not a reproducible business model across an entire market cycle. It's possible, and there are firms that figure out how to do it, but it's a very, very difficult game to stay ahead of the curve and ahead of everybody else on. And we're not in crypto for that. We're in crypto because we think it's going to change the way the world does business over 20 years. The same way the Magnificent Seven really drives the global economy today, we think there will be something similar to that in some ilk out of crypto that drives the world 20 years from now. And so that's the transformative tech change that we're working to allocate to. And the market neutral, even if we're great at that game, hails in comparison to the kinds of risk adjusted returns that we think we're seeking through crypto.
So we talked a little bit about that new fund that you all are raising that is going to have some aspect of LP secondaries in there. What are the other things that you are excited about and the growth plans that you have at Pure Crypto?
That fund launch is starting to take center stage for us. It will be a capital call down structure. We're hoping to get a significant amount of exposure to the secondaries, but otherwise it will be the same fund structure that we've been largely discussing already today. So it's not really a change dramatically from that sort of allocation bias to seek out the sharpest, smartest crypto allocators, and both on the venture capital and liquid sides.
Then I guess my question would be, why not raise it in one of the existing vehicles and just take on new LPs?
Great question. And I'm glad you asked. The reason why is because in these cycles, when the market really starts taking off, the marks on these venture capital positions can increase literally like 20, 50x, maybe 100x in 30 days. And so we realized early in our first fund vintage in the Pure Crypto 1 that in kind of late 2019, it was, if I remember correctly, when those marks started to change quickly, we realized we had to stop taking new capital, because otherwise we're penalizing the current LPs because they're actually accepting dilution to those tokens and those projects unwittingly so, because the curve of the growth was too fast to keep up with. And so from that moment, we decided, we're only raising these structures, even though legally they're technically open-ended structures, but we're simply not allowing them to take capital indefinitely because of that problem with marking the venture capital book.
I'd even add to that too, the venture capital marks, it's really difficult to mark an asset to its true fair value in crypto. People don't quite appreciate like what do you do with a token that you own that's locked for, let's say, 2 years, but it's trading on a liquid market with average volume, a few million a day or a week or something. And it's trading at 10x your cost basis. How do you mark that if you're locked for 3 years? Do you mark it to the market that there's a liquid market for it, but you can't sell it? So there's kind of these like arbitrary discounts applied to some of these locked tokens that are sitting on the venture capital book. And they are kind of arbitrary. Like there's no precedent for how you value something like that. So it's, some firms will market at the cost basis, and some firms will put a 25% discount on it, or 50%, 75%. I don't know. Like everyone just kind of makes up they're not makes up, but they just use different methods for valuing these assets.
That is the way it has been, but the ecosystem is migrating towards some standardization. There's a cottage industry now of independent third-party valuation firms, where most of the funds are moving towards hiring these firms to make those marks for them, because they don't want to be in trouble for making a a biased decision in some sort of conflicted way.
How does that work for like a performance allocation? And I know that this is a question I have for like traditional venture too. You get to the end of the year, things have done well, but obviously it's maybe not liquid yet. How do you guys go about marking your book? And then,
Yeah.
maybe I guess with coins, there is still something that can be split and put into the GP account versus, LP account. So how do you guys take performance allocation at the end of the year?
Yeah, it's pretty simple. It's you basically take performance unrealized transactions. So you're not actually in the venture capital book, like a token that's tradable, it's liquid. You don't require an actual realization. You're not requiring a tax hit. But in the VC book, you're required to have a liquidity event to market.
And we don't take our performance fees on the venture capital book until those assets become liquid. It becomes like an accrued incentive fee that sits in their balance or in their investor statement. Because like you said, you can't take an incentive fee on a mark that isn't real or isn't realized. So it is kind of like you have to handle it differently between the liquid and the venture managers.
So they're still seeing on their account statement as if it was there, but if, when the liquidity event does come, if it's different than what those marks were, they're going to get that reality, not
Yeah, it's like this is the net asset value of your venture book. Here's the accrued incentive if that were to be realized at that valuation. This is what you pay, but that accrued incentive can go up or down based on the marks over time. And then as that gets transitioned to the liquid, that crystallizes.
Yeah, from an accounting perspective, the accrued incentive doesn't translate over to our GP account.
Now, what about you said it's hard to value these things. What about on the liquid side? I mean, even still, if people are doing fundamental analysis of what they think the value of these coins are, as you said, Bitcoin has no cash flows. Like when you talk to these managers whose job it is to value these assets relative to each other, how do they value an asset and how do they decide it's time to sell or to trim or to buy?
Bitcoin's in its own arena in terms of how to value it because it is truly a standalone commodity. You're right, it doesn't have cash flows. I would say the vast majority of assets within our portfolio, though, do have a product that does generate some sort of revenue, and that revenue is accrued back to the token holders. And that is the basis for how you diligence these certain tokens, right? There's not a lot like anything that looks like Bitcoin or is trying to be Bitcoin and isn't, I think is a bad bet, right? If you have Bitcoin Cash, you have Litecoin, you have all these Bitcoin copycats, and then you have meme coins that are also not tied to a product with revenues. And you have any token that looks like that. There's some tokens that have products that no one's using, ghost chains, like just people where there's no users. They have a product, but no one's using it. I think largely you have to stay away from those. I think most of what a crypto fund manager is focused on is this product something people are going to use? If it is, how do the revenues accrue? How much revenue will it generate? And how do those accrue to the token holders? And if you kind of put all those pieces together, then you go buy the token. And yeah, like Jeremy said, you still have to kind of, in an artful way, dream about what the future looks like. But it's different than speculating on Bitcoin, where you're betting on an adoption curve of Bitcoin as a digital gold.
Okay. And on the use case side, and there's plenty of people who would say, okay, there are users and they're doing things, but they're mostly just moving money around within the ecosystem. It isn't quite facilitating anything in the real economy. And the example that I often get from people is like remittance payments and things like that. I'm like, well, the market cap of Western Union is like $6 billion. Like if the most real world use case you can give me has a market cap like under 10 billion, like why does the industry deserve this? I'm not in the ecosystem, so I don't really know what's happening on chain and what people are doing. But to the people who take that perspective that this is all internal, what are the real world use cases that you guys are seeing and that your managers are seeing?
I think your example of remittances is it's a fair critique. I think there's a lot more to crypto outside of just peer-to-peer cross-border payments. I think that will be a use case, but that's not primarily where we're looking. I'll let Jeremy talk maybe more about Helium and some of the deep in stuff, and I'll focus on DeFi. When you think about DeFi, I think you're trying to figure out what does crypto enable that the traditional financial system can't, or how is it becoming, how's it going to disrupt traditional financial services? And if you think about payments, like spending, credit card fees, that's 3.5% on every purchase. If you think about wire fees, that's $30 on every, transfer between people. Cross-border payments is a part of that. But then you also have the fact that most people are sitting on cash in a bank account that's earning no yield, right? So they have to put money in their brokerage account and buy, a money market fund. And then anytime they need to fund their bank account, they got to sell that, wait a few days, transfer to their bank account, and then pay the 3.5% credit card fee for whatever they want to buy. Crypto is going to blow all that up. Stable coins are going to blow all that up. And you're going to get this merging of your credit card account, your bank account, and your brokerage account are all going to get meshed into one application where I can manage my investments. I can hold cash that's earning a yield equivalent to like a Treasury. And then I can, from that same account, spend my money. And it all happens, the trading, the payment, the transfers are all, the blink of an eye and for nearly free. Right. And that's a model that's like going to absolutely blow up the financial system, not blow up the financial system, but blow up the business model of these firms that are, used to making money on people from yield or from credit card transactions. So that's to me, like the vision I see us like crypto moving towards, like that's going to save people a lot of money over a long period of time. And it's more capital efficient.
But if it's saving people money, who's making the money, right? Like, there are these businesses that are making that 3%, and they're not even like the biggest companies in the world. So if it is going to be this truly transformational technology and it's going to bring the price down, that doesn't sound like a lot of revenue to me.
It's not a lot of revenue for, the big giants that are used to charging 3.5%. It's a lot of revenue for the smart contract platform that this app or, these financial services are trading on, because they're going to earn transaction fees. And then the users are going to earn the yield if they're going to hold, a stable coin that earns a yield or a tokenized treasury or whatnot. So there is going to be some transaction fees, and the revenues are just all going to get concentrated on chain versus, spread out between Visa and Chase Bank and, Charles Schwab and all of that. So
In a way, you could say the pie is shrinking for sure. Total revenue shrinking because you're cutting middlemen out. But the remaining pie is going to be redistributed primarily to the app developer, because it's code. There's no home office, there's no CEO, there's no HR, there's no payroll. It's the app developer and the app owners, which are the token holders. And I think there's another little asterisk here that's really fascinating to me, which also gives us excitement for the bull market continuing this cycle, which Zach mentioned the word, getting a treasury yield. The reason why stable coins have suddenly become, in my opinion, one of the reasons why stable coins have become so politically important is because the stable coins are ultimately going to be backed by treasuries. And that's a huge reason for the U.S. to get behind them politically, because it extends the dollar's Federal Reserve currency standard longer and deeper across the planet. Because crypto can be traded anywhere if you've got a Wi-Fi signal, and so these stable coins can be exported to countries that heretofore we have not been able to export them to, and essentially we're exporting treasury. To go back to where Zach wanted me to talk a little bit about helium. Helium's the poster child for why this use case is going to get bigger. You may already know the story, but helium is a global network of hotspots that, instead of a cell tower, which has a signal that maybe sends a 10-mile radius, you're broadcasting a signal a few hundred yards, and you're doing it from a guy who wants to put it in his windowsill at the office, or and it's a $500 unit, and basically Helium was able to stand up an entire 5G network at 1/100th the cost and 1/100th of the time, that maybe not 100, but much faster than the legacy telecom giants, to the point where it works so well. They're all using Helium's network to backstop their own. It's really hard to put a new cell tower in Manhattan or in downtown LA or in San Francisco, and it's really expensive. It's not hard at all for Helium. And so that you find these major carriers actually renting Helium's network in places where it's just economically far more profitable for their own network to do so. That same thinking is been extended to mapping, like Google Maps. Google spends an inordinate amount of time and money and effort and energy having these expensive cars drive all over the country, mapping the roads. Dash cams are being put in Ubers and long haul truckers. People that are already driving the roads are finding additional sources of revenue just for taking a picture of where they're driving through a company called Hive Mapper, or through a token called Hive Mapper. And they've already mapped roughly a third of the roads in the world using this. And their maps are actually better than Google's because they're refreshed constantly. So you think about the idea of self-driving taxis. The map can't be 6 months old. Like if there's a garbage can in the road, it matters. And so if you've got a higher refresh rate, that map is actually much more valuable than the Google map, which is 6 months old. And so we're just finding really interesting, and these stuff will iterate. Like I like to make the comment about the internet bubble popped in 2002, right? But the internet giants that run the world didn't stop growing. In fact, Facebook didn't even get launched as a company until 2004, and I don't think it went public until 2010. So much, maybe a decade after the idea had even come to fruition and popped, some of the most transformative technology in the space hadn't even showed up yet. So we think that will happen in crypto as well.
All right. Well, I want to close with a question about new managers entering the space. You obviously, in many ways, are one of the gatekeepers of capital in the crypto hedge fund world. You haven't moved into any new managers, but if you were to give advice to a new manager in the crypto space, what would you tell them to focus on to attract capital from people from this more OG cohort vintage?
My advice would be to really hone in on what your edge is and stick to who you are from an identity standpoint, like as a fund. I think it still remains one of the best sources of alpha or edge in this space is just kind of like the ability to go find really world-changing ideas and hold them through volatility. The ability to hold assets through volatility without taking leverage, without trying to swing trade the market. I think that's still a great source of edge, is just go find really, really compelling ideas, develop a conviction, and then hold them until your thesis plays out or it's validated. And I think managers that kind of stick to that and avoid the temptation to trade or the temptation to try and juice returns through leverage of any type, the all-weather funds, like we kind of mentioned, I think the counterparty risk is a little underappreciated there. So I think just avoiding those traps and getting an LP base that buys into that is my advice, because I do think that is what produces the best returns, even though it does come with painful drawdowns in a bear market.
I would say I don't feel particularly qualified to give advice to these guys, but I could tell you what we look for in a manager. And I'd say that the buy box for us is basically somebody who's OG in the space, who has really, really deep knowledge in crypto from the cryptography side, as well as being able to write open source code and understanding all of those things, that's connected to the network of the smartest guys in the room. Because this is something that's done better in a group. It's not something done well in isolation. And then if you have those ingredients, that's a must. If you don't have that, we're not interested. But if you have that, and then you have a disciplined, well-reasoned, first principles approach, and you're willing to be and to go against consensus, and basically in a humble way, continually get up every day and challenge your own assumptions. It's not wrong to make a mistake. It's wrong to be stubborn in making mistakes. Those are ingredients that we think make for the recipe that is why our managers have done better.
All right, well, we'll leave it right there. Zach, Jeremy, thank you so much.
Thank you.
Thanks for having us.
As a reminder, this episode of Other People's Money is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs giving investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMH Max and SMHX Max to learn more.